Welcome to Code and Concrete, the leading podcast for prop tech, conversations about the built environment, and other exciting innovations. If you learn something new, please consider following and leaving a positive review. Enjoy. Hi folks, welcome back. Joining me in the studio today, I have Erkan Yönder, and he is an associate professor of real estate and finance at the John Molson School of Business and director of the Jonathan Wener Centre for Real Estate at Concordia University. He specializes in commercial real estate, REITs, climate risk, and AI-driven analytics. As founder and director of ReFin, or ReFin, Quant, he works closely with institutional investors and industry partners to deliver data-driven insights for valuation, risk management, and sustainable investment strategy in real estate. Erkan, thank you so much for joining me on the show. I hope I pronounced everything properly in the introduction.
No, I mean, it sounds perfect, Matthew. So maybe it could be the best English pronunciation of my name. I'm very happy to be here. It's great to have to do this together with you. I'm very happy to be here.
Yeah, absolutely. Well, best pronunciation. That's a medal that
yeah,
I will
exactly.
wear. I love that. Awesome. So we're off to a great start. And this is going to be a very unique episode because the claims that you bring to the table, especially about REITs and affordable housing, are not what the headlines typically say. And so we're going to be demystifying some of the confusion about renting and ownership, affordability, supply, demand, and the current stock of housing, all of the math that's going on there. First, let's start with an introduction of yourself. How did you get here today in real estate and as a professor? What was your journey?
Okay, I'm originally from Turkey, so I studied economics, and then I figured out that okay, if I do economics, I should do more policy. So maybe this is a little bit controversial to say, but I didn't want to do policy, to be honest. And then I thought, okay, what should I do? And I switched to finance, and real estate was very attractive. So I was looking for a PhD position, and I moved to the Netherlands. So I had my PhD at Maastricht University in real estate finance. And immediately, I started with real estate investment trust in my PhD dissertation. I did green buildings, actually. We started working on green buildings by 2009. I mean, my supervisors were very active. And by the way, they are the founders of GRESB as well. So we started working on sustainability in real estate and commercial real estate, of course. I mean, I kind of touched every part. I always tell people that I'm not directly housing. So if I say real estate, I'm not housing, but I'm really in the commercial real estate domain. And after my PhD, I became a professor in Turkey for some years. And then I moved to Canada. And since I came to Canada, it's been always the institutional side, I would say. Pension funds are very active in Canada. So I started to get more interacted with the industry, especially in the pension fund domain, especially in the real asset side. So, I touch almost every part of commercial real estate, like mortgages, REITs, sustainability, AI. I mean, we can discuss those if you would like. Yeah. But that's more or less my story. Yeah.
Awesome. Well, it's a interesting story because you've seen real estate in so many different parts of the world. And there's certainly some commonalities, but some unique nuance to each market. And diving into the research papers that you had sent to me previously, that was one of the things that I picked out. That nuance is so important in terms of where institutional investors are creeping into the residential market, the actual numbers behind it, the correlation to housing costs and rent. You have to be very particular. And the broad sweeping generalizations that we've seen where they say, well, 8% of the market is owned by institutions in the US. That's just not accurate. Or there's this growing rate of acquisition among these institutional investors, and it's rapidly driving up rents unsustainably because they have no market competition. Really, these claims don't have as much substance. Now, the activity itself might be there, that an acquisition is happening, but the underlying evidence and the numbers don't really match up to how people are perceiving what's going on in the market. So let's kick it off right there. So the claims are typically that institutional investors, people will name drop BlackRock and Blackstone, are going into markets. They're buying owner-occupied homes, so the typical house that comes to mind.
Exactly.
and they're converting it into a rental property. And they're doing this en masse, and it's causing prices to go up because they have enough capital to outbid other buyers. So maybe a family of four that's looking to move into that same house, they would not have as much capital at their disposal. And once you accumulate enough stock in a certain market, you don't have as much typical competition, like the ma and pa landlord that has a few properties and they're just looking to collect rent. And so as a result, people claim that rents go up. And really, the evidence is all contrary to that, which is interesting. So
Yeah.
when we look at the data, how would you say that this sort of investor activity is actually impacting homeownership rates, rental rates, and home prices?
So let me take it from the beginning. So let's think about the affordability problem. So I mean, I kind of mentioned that I had my PhD at Maastricht University. So after my PhD, we always, time to time, we come together with my former supervisor. I mean, we have 8 projects together. So it was a couple of years ago. So we came together at a conference, and I said, Pete, like, what? His name is Pete Ahios, by the way. I said, Pete, what should we work on? What's the next big thing in real estate finance research? And he said, and it's a very big topic everywhere. So he said, like, affordability is a problem everywhere. It's a problem in Turkey. It's a problem in Europe, in the Netherlands. It's a big problem in Canada. It's a problem in the US. So he said, like, I don't understand the puzzle here because we have an affordability problem, and the solution to the problem is building more. So if you build enough, then there won't be an affordability problem. But it's a big puzzle. So it's a problem everywhere. And it's kind of right now not solvable. Like, we cannot solve this problem. And how I started this project is like the debate in the Canadian market. So if you look at the Canadian media, they're like, you can see articles that institutional investors, real estate investment trusts, they come to the residential market, and what they do is that in the end, the idea is institutional investors and REITs invest for returns. So it's not shelter, it's not consumption. So they don't consume. So their target is generating returns. And of course, this brings in a debate in the market that, okay, like, these people, these institutional investors, these companies invest in the residential market for profit purposes or cash flow purposes. So maybe they are the ones to blame with the affordability problem. So if I take back the affordability problem, I mean, there are many different cores, as I told you. Like, I'm not like a core housing person, but the easy answer or the first thing that can come to mind is urbanization, right? So we started to live in big cities, in major cities, and there was a very fast urbanization across the globe. So this created some kind of a supply-demand mismatch. And of course, if there's a supply-demand mismatch, prices start to go up, and of course, investors will jump into the market. So that's why the perception comes out. So I don't see any problem to question that if institutional investors come to a market or REITs come to a market, to a residential market, do they increase the prices? Do they increase the rents? I mean, I think it's an empirical question, right? So, like, you can justify this, but you need to look at the data, and there are like counterparts of this question. So that's how I started. So it's a big debate in the Canadian market, and there are Canadian REITs. So my focus was on not the general institutional investors, but my focus was on real estate investment trusts in the residential market in Canada. Like, I came across a really nice data set where I can observe individual multifamily building rental data. So I started the project. So I had the information about the owners, so I could identify whether the owner is a REIT or not. And then I started to dig into this question. So maybe I'll tell you later as we go deeper, but the main finding in my study is that REITs don't charge higher rents, but this is conditional on something. So the rents are not different. So you said something very nice, like, we are not talking about correlations here. So I'll go deeper maybe in the next questions. So correlation is a different story, and perception is a different story. But what the data tell you is another story. So, and the data tells us that if you really control for the quality of the building, what I mean by quality, it's the surrounding, the neighborhood, it's the building amenities. And I had a very rich data set on the amenities. So I had tens of different amenities for amenity information for different buildings. So after controlling for the neighborhood, after controlling for the amenities of the property, then the REITs do not charge high rents in Canada. So then I converted into an academic paper. Then, I started with Canada, as I told you, and I came across two US studies. So it's a very hot topic. Actually, like a few days ago, I got accepted from Aroa's national conference with this paper, for instance. I mean, it's a hot topic because affordability is important. The role of institutional investors is not very well known. So there are, like, I would say 3-5 papers, academic papers out there on the topic. And I came across two US papers, for instance. So what I'm looking at is I'm looking at the multifamily properties, and the other two US papers, they look at single family properties. And in the rental market, their findings are very similar to mine. Actually, one of those papers finds that there's even a decline in the rents if institutional investors enter a market. In the pricing side, they find very small, in economic terms, very small increases in the ownership side, in the price side. So, but for instance, I can give you one statistic. I mean, I just opened it for the. I'm kind of cheating here. So, for instance, if single family REITs invest in a market, then there's like a 0.14% increase in the prices, as opposed to during that period, the increase was 6.7% annual. So which means that actually, like, there's this much increase, only 2% of the increase are explained by REITs involvement in that market. So the impact on the prices as well, it's tiny. There are different reasons, but overall we can confidently say that like REITs, when REITs or institutional investors invest in the residential market, either multifamily or single family, it doesn't matter. So we don't see increasing the rents. Even we observe declines depending on the setup, and we see modest increases in the house prices. They're tiny, and the advantages goes back to the initial point. So why do we see unaffordability problem? Because there is a demand and supply mismatch. And actually, these institutional investors bring in capital to these markets, so they increase the supply in these markets. So, like I think the perception in the market is missing out. So these institutional investors, real estate investment trusts, they bring in the capital into these markets, inject capital, because in the end, the core problem of affordability is supply. So they help increase the supply in these markets.
Right, which is very, very interesting. These institutional investors operate at economies of scale,
Exactly.
and therefore they have this ability to essentially increase the stock. They have the capital at their disposal. I mean, you're seeing a balance of two things. You're seeing them operate the existing stock more efficiently, and then you're seeing the ability for them to expand beyond that. Whereas your typical landlord who owns 3 properties is not going to be developing a 4th property. It doesn't make sense.
No.
However, if you're operating at such a scale where you have thousands of units, you can then expand, which is one of the interesting data points that for, and I don't have it exact if you have it, but for every unit that is acquired, there's like 0.5 additional.
Exactly.
I don't know if it was units
so
or houses.
If they own, I think, one additional house, there's like a 0.5, like half of a house increase in this. So let's say if they own 2 more, then there's one increase in the housing supply, one property increase in the housing supply. So actually,
Right.
it's kind of offset, right? So they come to the market, but they add to the supply, so which kind of lowers the negative potential impacts on the pricing. So actually, they increase the demand coming to the market. So that's maybe the point or perception, but they also increase the supply. So the supply increase kind of offsets the potential price increases by the increasing demand in that market. Exactly.
Right. And they're either doing that directly, or because there's that initial wave of demand, this attracts more builders who then construct. And so there's direct and indirect consequences of that. But it seems like the net outcome is that it eventually settles at a surplus of supply, and that, or a surplus of supply because there are more units being developed in the end. Is there any data about how long it takes for that effect to come full circle?
That I don't know directly, but let's kind of open the box. So think this way. So there are so first of all, these are not the end users, right? So the number of end users in the market, like the people kind of I use the term like consume these properties, right? In the end, they need shelter and they live in these buildings. So the tenants or the homeowners, or owner occupiers, they consume these buildings. So think this way: these institutions come into the market, but their target is renting them out. So actually, that kind of creates kind of a switch from one market to another. It's like rather than the timing, I think it's more about resplitting the supply across rental properties and for ownership. And so when these institutions come into the market, so there's kind of a fixed demand in that respect. If you think about the end users, so either people owner occupy the property, or somebody rents that property. So these are the final users. So this, like, they could impact the demand, of course, but in nominal terms, in global terms, this number is fixed. So the people who need shelter is fixed, let's say. So what these institutional investors do is that they come to the market, so they buy the properties and they make them rental. So there's an obvious increase in the supply side in the rental market. So you can think of that. Okay, there are more rental properties in the rental market, and then that creates like an increase in the supply in the rental market, so which could help with the rent. So maybe rents make sense in that respect. Or you can also and that's one of the perception. Somebody can also claim that, but these people have they're just seeking returns, so they could drive up the rents. So, but this doesn't fit to the demand and supply connection, right? You can only increase the rents as much as there is demand outside. So you cannot really beat the demand, and we know that there is already a large demand. So if you come to the supply side for the ownership, they still didn't kill the market, let me take it that way, because they built more. So while they're converting some of those properties that are owner occupied or owned, they move those properties to the rental market, but they also add supply to this market. And they do it in both markets, not only single family, they do it in single family and multifamily at the same time. So that kind of offsets the impact. So the timing, I don't remember any findings about the timing, how long this takes, but you can think of it like a continuing process, because they have different options. They can either build or buy an existing house, renovate it, and then rent it out. Or they can do the same thing with multifamily as well. They can buy an existing multifamily building and then rent it out. So this is like an ongoing process, but that's the idea. So the offsetting impact comes from that these institutional investors or REITs increase the supply in these markets. So that's how the mechanism works here.
Right, right. And then of the houses that they are acquiring, there was another interesting trend, which is that these institutional investors are reinvesting more into the stock that they acquire, and essentially modernizing what is an aging housing stock. And that's very important to bring up, because it's not just the rate at which we can build new houses, but it's the rate at which the current stock,
Exactly,
what would be the right word, disappears, to put it simply. And so you have this constant balance between what no longer exists, what currently exists and can be restored, and then how much new stock on top of that do we have to develop. But just looking at the reinvestment portion, what impact would you say that these institutional investors entering the market has on the quality of the rental housing over time?
I mean, Matthew, I love that you mentioned very important about reinvestment, because that's the main contribution of my paper. So first, I show in the paper that there's no higher rents charged by these real estate investment trusts. But the second part of my paper is all about reinvestment. So I can give you some statistics. So in the Canadian markets, at least in my sample, and I'm covering the Toronto market, the average age of the individual multifamily property is 52 years. So there's an old stock out there. So that's number one. Number two is that think about rent controls. So Toronto market has rent controls. I mean, they have two segmented, so I'm not going into those details, not to confuse anybody. But if you want, we can go into those details as well. But overall, there are rental controls. So as long as you have a tenant, and if your tenant wants to stay in that building, there's a cap that you can increase the rent. So, and this creates a problem. So there's a large academic literature. As I told you, I'm not an urban researcher. I'm in the commercial domain. But when I first wrote this paper, I dig into the literature, and then there's a debate in the academic literature that if there are rental controls, that creates a disincentive to renovate the properties. So just think, you own a property, you rent it out, and your tenant stays there. As long as the tenant wants to stay there, they pay the rent, they stay there. So you cannot jump the rents. So, but maybe you want to improve the property, you want to make some capex, or you want to install something to your property. So you spend for that reinvestment or for that renovation as an owner, but you cannot charge higher rent. So those costs are absorbed by the owner. So this creates the disincentive. So then the only time that they can, they are up to renovating the properties is that if the tenant leaves, then there's like an opportunity to increase the rents because it resets if the tenant leaves. And then maybe they can do more renovations also. So that's a big problem. So that also keeps the stock older because we have such rental controls. And as I told you, like there's a big literature on this as well. So that's the difference these institutional investors make. So what they do is that they invest in properties and they continue to renovate these properties. So according to my finding, I remember the others that I don't remember. So I look into the building permit data, and I know you're interested in AI and data science in real estate. So what I did with my team was that we collected the building permit data publicly available in Toronto. And we created like a generative AI model, very simple. Like we created some prompts trying to categorize the building permits. And of course, we also use data science to collect the data, the publicly available data. So we had, in the end, 700,000 building permits for the Toronto market. And so we identified for each property when an owner gets a permit for those individual properties. So we collected this data. So what we find is that roughly, if a property is owned by a REIT rather than otherwise, they have 74%. They're 74% more likely to have building permits than the other owners. So what does this mean? This means that if REITs own a building, they're more likely getting building permits to renovate the properties. And then, as I told you, using generative AI, we categorize and we determine the building permits that are environmental. And actually, they are twice likely to get an environmental permit than other investors in the market. So what this means is that actually there is the modernization and reinvestment impact if institutional investors enter these markets. Because in the end, quality is important for these institutional investors. And they maintain, and also, I think you kind of touch in our conversation to that. So it's not in my paper, but it's in one of the papers. There's also operating efficiency by institutional investors. So I think in your example, you said you own 3, and then you won't go to the 4th one if you are not like a large institutional investor, right? So, but these institutional investors can own many properties. So they develop the expertise in property management as well. And they create economies of scale in your wording. So they create economies of scale. They can decrease the operating expenses. So these are really helpful to renovate the buildings, to maintain the quality, and even to lower the rents. Because if your operating expenses go down with efficiency or economies of scale, then there is a chance that you can have a lower NOI in that respect. So all things together, these institutional investors reinvest a lot, more likely to reinvest in these properties. And they do reinvestments in the environmental domain. And, it's very important for Canada. And environmental issues are very important in the real estate domain. So if you think that 70% of the electricity consumption comes from these properties, so REITs and institutional investors can play a great role, because the main problem about environment is also the old stock. And as I told you, for instance, in my sample, the average age was 52 years. So we also need to renovate and make these properties more environmental. And REITs and institutional investors help that. There's one more thing, and that brings us back to the demand and supply relationship. They renovate, but in the end, they offer amenities with these buildings. And think this way, this is like a comfortable life for the tenants in the end. So they do new amenities or improve the properties based on the demand by the users of those buildings. So, and that's also another point. So it's like they renovate, they reinvest in these properties, but there's demand for these amenities. There's demand for maybe young generations. There's demand for coming from the tenants using these properties. So I think that's also important to offer a comfortable life. And if you consider especially that we have old stock in the market.
So we started with the impact on rents, which is, it seems like the conclusion, generally speaking, is that there is no substantial impact. If we look at the actual causation, not correlation, rents are going up. There's no
Yeah,
doubt about that. But there's not a direct causation, meaning that the presence of institutional investors in the housing market is not intentionally increasing the rental rates. In fact, it's having the opposite effect.
exactly. Exactly.
Then on the quality of those properties in which people are paying rent is dramatically improving because there's modernization, there's renovations, and then there's more subtle things like environmental friendliness or environmental impact, which is being improved because you have more efficient components.
Exactly.
Things are more up to code or even exceeding code. Let's look at the housing prices, though. So the price of the asset outright, not what you pay monthly, but the overall cost of that. There was interesting data about, you have the rise of home costs, which is a big concern for everyone, whether that's a down
Exactly.
payment, a mortgage, or a monthly payment in rent. But the the headlines are also misleading here. So what's the reality about the relationship between these institutional investors and the prices of the homes themselves?
So let me start with the correlation point, because this was something I wanted to emphasize, and that's the way I wrote the paper as well. So forget about the quality, forget about the neighborhood. Just look at the correlations. Okay, if you look at the correlations in the Toronto market, so if a property is owned by a REIT versus if the property is owned by a non-REIT or non-institutional investor, let's say, after we find positive correlation. So if a property building is owned by a REIT, you see that there is a higher rent. In Toronto terms, in Canadian dollar terms, so on average, REITs seem to charge from $130 to almost $180 per unit. But if you look at the average rents in Toronto, it's around $2,100 in my sample. So it corresponds to 5 to 8% higher rents for properties owned by REITs. But this is correlation. But these properties have higher rents in nominal terms, let's say, or in correlation terms, not because REITs are greedy or charging higher rents. It's because of the quality of the building. So it REITs own in certain locations, maybe the location is higher quality or like the house prices are more expensive in that location. And like it's very much evidence in my paper that REIT properties offer more amenities than otherwise. So whatever comparison you make, so you shouldn't just stick to correlations. You should compare apples to apples. Like you shouldn't compare apples to oranges. So I think that's one driver of that perception. So going back to the house prices. So as I said, there is that transition. So when an institutional investor or REIT enters a market, so properties can be moved from the owner-occupied market to the rental market. So this creates like a supply issue on paper or on easy terms, but REITs add supply or institutional investors add supply to that market. So if you think that, I mean, that the major problem is supply. So again, I always go back to that point. So for instance, we need subsidized housing. There's no doubt about it, but we cannot subsidize every market in every country. So it's not financially possible. So in the end, we need to build more. That's the major problem. So I mean, just think about urbanization, for instance. I mean, if you think about downtown cores or metropolitan areas, not the peripherals, but the metropolitan areas, you see that like the land is restricted, like not enough. There's like insufficient supply. Like you cannot build more. The only way is maybe you can do vertical supply increases, but it's still limited. But whatever you do, you need to build more. There is like if you want to expand the supply, if you need to build vertically, then you need a capital injection into this market. So that's the major role of institutional investors and REITs. And REITs are the same, by the way. I mean, don't think REITs as just investors. Actually, REITs also attract institutional capital. So institutional investors, pension funds own shares of REITs. So they inject capital into the REIT market, and then REITs invest in buildings in those locations. So there are like these two counter impacts. So they withdraw owner-occupied properties, which will impact the prices, so lower the supply if you take it alone. but they also inject capital so they can increase the supply. So based on these, the findings are that, as I said, in one paper, they find that there's only like 0.14 percentage points increase in the house price. It's very tiny. And at that time of the study, the price increases are 6.7%. So 0.14 percentage points versus 6.7%. So that's the increased impact, the price increase impact of institutional investors or REITs in that domain. The other paper finds a little bit a larger impact, but still it's modest if you think about the general trend in the markets. And both papers, and also that's my explanation in my paper. All these three papers explain that institutional investors help with the supply side. And that's kind of dampens or limits the house price increases, if there are any. It depends on the market as well. And there's one other thing in one of those papers. So I'm really jealous because I didn't check that part in my paper. So the author looks at like the income level in that market that an institutional investor enters. So let's say it's a high income market. So what institutional investors do as well, so because they offer rental properties in those high income markets, what happens is that let's say I'm a middle income family, and I cannot buy a house in a high income location, so I cannot penetrate into that market or live in that neighborhood. But if an institutional investor or REIT enters that market, and if they offer rental properties, with renting the unit, I can have access to that location, and that's what they find. So through offering rental properties in high income locations, so lower income level people can also penetrate into those markets and have the opportunity, to blend. And by the way, that's really important. Blending people with different income levels, that's very critical for in social terms, to be honest. And
Now,
just one note, Matthew, just one thing also, one of the papers also find that there's no impact in the mortgage markets. So there is no like institutional investors entering to these markets, or REITs entering to these markets don't have any impact on mortgage availability or mortgage rates available to owner occupiers. Like there's no significant impact, so they don't impact the lending terms for the owners. Yeah.
right, right. That's a good point. If you qualify for a mortgage, then you can continue to own as you traditionally
Exactly.
would. The REITs and the institutional investors being present in the market doesn't stop you from buying a house
No.
if you could have previously purchased a house.
Exactly.
That's a good point. So if REITs and institutional investors have such a tiny impact on the overall cost of the house, why do you think that they have become the scapegoat for the affordability crisis that exists? And the policies that have been introduced that would punish REITs and institutional investors, what do you think about those? And again, why do these fail to address the real issue at hand here?
I mean, I think now we have three papers. Maybe there are more. I mean, I know three papers, including mine. So maybe we were lacking evidence there. So as I told you, and that's why how I structured my paper. So without controlling for quality or other factors, what I do in my paper is that, as I told you, I check the rent differences if a building is owned by REITs or non-REITs, and I find differences around, as I told, 5 to 8%. So that's the perception. So if you don't use data analytics, if you don't use, let's make it AI a little bit fancy, methods are moving towards AI. Of course, if you don't use data analytics here, but what I mean data analytics, of course, the right methodologies to identify these impacts, these differences. I mean, on paper, you can only observe the correlations, and the correlations tell you a different story because REITs prefer to invest in certain market. They prefer to reinvest in these properties. They prefer to offer more amenities in their buildings than otherwise. Of course, in nominal terms, these have an impact on the rents. And that's what the market sees if they look at the data. So I think that's where maybe people like you and me and other academics can kick in and help the policymakers, investors and the public understand the right message or the right story in these relationships. So that's and also it's easy to blame, right? I mean, in the end, if you say that, that part, by the way, I don't understand. So in this debate, so REITs, institutional investors seek for returns. Yeah, but I mean, I own my house, let's say, and I want to buy a second house and rent it out. Yeah, but if I rent it out, if I make an investment in the housing market, my purpose is also making returns, right? So that separation doesn't fit to my mind, but there is that connection as well. So people think that these investors are seeking for returns and profits, and they increase. So but again, data can help. And one last thing to say, and as I told you when you asked me about my background, I said I started working on REITs into my real estate career. That's what I love about REITs, to be honest. Like, just think about, like, for instance, the average house price in Toronto is, I think, it's changing a little bit right now, but last time I checked was $1.6 million. So the average house price in Toronto. I think in Vancouver, it's 2.1 million or more than $2 million. So I'm a fresh graduate. I studied top schools, but my family doesn't have any wealth. So what can I do? So I don't have any access to the housing market. And that's where REITs kick in. I cannot invest as a, let's say, successful person, very hardworking, maybe a bright future, but I don't have any wealth coming from my family. And REITs can offer me to invest in the residential market. Even if I have $1,000, a few $100, I can buy REIT shares, and I can have access to the residential market. While if we don't have REITs in that domain, then I don't have any access to the housing market then we just leave the real estate markets, residential markets to people with certain wealth. So that's a REIT story. And if you think about institutional investors, institutional investor money is our money. I mean, pension fund money is our money, right? So pension funds are investing in the residential market on behalf of us as well. So there is that impact as well. So, I mean, I think we shouldn't miss out that part. So REITs, institutional investors, yes, that's correct. They seek for profits, but in the end, REITs and institutional investors are also channeling capital into these markets, and small capital. If I don't have that income, then I cannot invest at all in the real estate market. So I think we should also consider this if we debate about the role of institutional investors and real estate investment trusts, I would say.
Mm-hmm. Very good points to bring up. Starting with the data portion itself, if people were more aware of the data, I don't know if this was the US or Canada, but I mean, institutional investors in REITs have been around for decades. And yet, today, they only constitute, I believe it was 0.2%.
Exactly. It's not my paper, but one of the papers. You're right. Exactly.
That's a very tiny amount considering the amount of time that has passed and allowed for the accumulation of the assets. So it's not like it's been some sort of takeover of the real estate market and nobody owns homes anymore. It's been very gradual. And then even at the end of the day, it's still a very small amount. Now, in certain city centers, I believe that number increases dramatically, 4, 5, 6%. But still, those are isolated incidents, and broadly speaking, 99.8% of the market is held by your traditional landlords, so ma and pa, boutique, let's say, investment firms, just a small portfolio.
Family offices, for instance.
Right. Yeah. Someone who has an extra house and rents it out, or just outright owner-occupied. Someone lives there. That's their house. So putting that data forward drastically changes how we perceive the role of institutions in all of this. And then the point of being able to invest in those same REITs is also a great point. Nothing is stopping people from investing in the same entities that are supposedly capitalizing on these houses. So if that's what you want to do, if you believe that it's lucrative and they're buying up the real estate, then you can also invest in those. Now, there's a caveat, which is that it's not direct ownership, and the returns, I believe under U.S. law, 90% of the capital has to be redistributed.
I mean, that's actually why the REIT system is built up. That's the purpose. So just think, if you own the REIT, if you own real estate through REITs indirectly, so what happens is that REITs are restricted to invest in real estate. So they can only or mainly invest in real estate. So they buy buildings, they rent out, so they generate NOIs or rental income through these properties, and then they have to distribute 90% of that amount back to the investors. So it means that actually if you own a REIT share or versus if you buy a house directly and rent it out, it's the same thing because REITs cannot take over the rent from you. They have to distribute the rent back to you.
Right.
And there is no double taxation as well. I mean, that's also another debate going on in the US and in Canada time to time as well, that REITs are tax exempt. So they don't pay corporate tax as long as they distribute 90% of, but it's the same logic. So by removing the corporate tax, you tax real estate investors in months. So there's no difference from, so in let's say nominal terms, it's the same thing. If you invest in a property directly, so you pay taxes once, or if you buy a REIT stock, they don't pay corporate tax, but you pay taxes on your rental income through the REIT. So it's the same. The taxation part becomes the same. And REITs have to distribute 90% of the income, and that's the only type of corporation that has to distribute 90% of the income. So you kind of guarantee that you collect the rents as a REIT investor. So I think that's the point about the REIT system. So it gives people access to the real estate market. And I think we should also forget one thing. So real estate should be, or that's how it is historically, that they are less riskier than stocks. So the risk is less, returns are more solid because there are rental contracts. So you can generate on average, let's say, or in theory, lower returns than, let's say, technology stocks, or you take less risk than investing in technology stocks, but you take more risk than bonds, and then you get a little bit more returns from bonds. That's how real estate markets, and that's the purpose of REITs as well. But affordability creates a problem. Affordability creates a volatility problem in this market. So with affordability issues, we see jumps in the prices and then declines. So real estate becomes more volatile. So affordability is really like diverging us from the purpose of real estate investment. And again, the solution is supply. And the only way to increase supply is bringing capital into these markets. And the best vehicles to do that, like institutional investors and real estate investment trusts.
Real quickly, I want to comment on the risk portion. There's substantially less risk with these institutional investors than your typical landlord because of oversight, operational efficiency, reporting standards.
Exactly.
Like just an investment firm versus a publicly traded REIT, the requirements and of disclosure and reporting and financials substantially different than just private real estate ownership. So if 99.8% of the real estate is held in these higher risk models, that's an interesting dilemma. Now, I'd like to see how different technologies we're talking about, AI and analytics. I would include blockchain and tokenization. How this could include new investment models into private real estate if the real estate is still being acquired and developed, but maybe it's not institutional. Do people still have a fair shot of investing in that? And I think that model is going to evolve over time. And the other thing is that would be direct ownership. So there's different tax benefits of direct ownership versus a REIT, and then also different liquidity options. So just putting all of the options on the table, I think, is going to be very beneficial so long as we can come to terms that these investors are not necessarily the boogeyman and that there are larger industry, so real estate and construction issues, macroeconomic trends, all sorts of things going on that have led us to this point, and also generational wealth. I mean, the average age of a new home buyer in 2026 is mid-50s. So there's something going on there as well, where people are choosing to live, what they're choosing to do with their money, and how they want to accumulate their wealth. A lot going on, it's a lot to juggle, but we got to have the conversations for people to start to hear these points, and then maybe adjust how we approach policy making or investments.
And as we discussed, data analytics can help to develop the right politics and to have the right perception about the markets. A couple of things were very interesting in what you said. Like, for instance, I have a fresh graduate nephew, and he's super into real estate investment trust because he says, it's more liquid. I can easily invest. I don't need to save money to buy a house or so. and so on. So I think for the next generation, it's a great investment tool. And I want to give an example. I tell this story maybe almost everyone. So I had my PhD in the Netherlands. I moved back to Turkey. I was a professor there. I've been very active across Europe and coming to the US, especially on the academic side. But then in 2018, I moved to Canada, to Montreal, and it was my first day in Montreal. I went to a bank, and I was just opening a bank account, and the guy there asked me what I'm doing, and then I said, I'm a real estate professor. And the next question was, okay, what will happen to the prices in Montreal? House prices in Montreal? I said, I just came yesterday, yeah, I'm a real estate professor, but every market in real estate is really unique and you need expertise. And that's kind of what institutional investors and REITs can offer. So just think that, let's say as a newcomer from Turkey, yeah, I'm a real estate professor, but I know nothing about the Montreal real estate market. If I invested at that time immediately, most likely I made like a wrong investment decision or so, because I don't have that expertise about that market. So it's not easy, and it's a lot of it's hugely capital intensive. So I use in my classes this sentence or statement all the time that it's a lifetime investment for many people. So it's the major lifetime investment for many people. And like expertise can help here a lot, and I think REITs and institutional investors offer that. So back to data analytics. Of course, I won't comment anything about blockchain because you are the expert here. But blockchain is also, I think it can offer transparency to the real estate market. It can help again attracting capital, right? That transparency that we can bring in to the real estate market through blockchain technologies can attract more investors into the market, and that's maybe the core of our conversation, that we need more capital into real estate market. And of course, AI or data analytics models. Now it's very interesting, right? I mean, everybody is asking the same question: what will happen to different professions? What will happen to future jobs with the AI? And real estate is no exception. So AI is there; it's improving daily. One thing we should be careful, because real estate business is more traditional. So that traditional, and it's in general the case for the real estate market. So technological adoption in real estate markets is slower than other markets. But again, I think institutional investors, real estate investment trusts, I think they're faster in adapting new technologies than local investors, as you explained those. So I mean, technology is there. It's real estate is no exception. And one thing is really important. So I think it's the paradox, right? So in real estate, we are slower by adapting technology than, let's say, financial markets, for instance. But at the same time, we need more technology than other markets, because financial markets are very liquid, high frequency data, lots of data availability. But real estate markets are very low frequency. I mean, I think he's not hearing me, but my next door owner, like my neighbor, I think he bought the house 45 years ago and he never sold it. So just think about the next door house. It's never being transacted for more than 40 years. So there's no price update on that unique property. So if this is the case, then we need more help from data analytics. And I think your question was a great question. So while we have such analytical findings, why there is that perception? Because real estate markets are illiquid. So it's not easy to understand by looking at simple correlations or so, because we don't have frequent data. And again, like we need blockchain, we need data science, we need AI into these markets, definitely.
I have to hold back from going on a 50-minute lecture 50 minutes into this episode. But as you start talking about apples to apples and correlative data and comparable assets, as well as data availability and symmetry, transaction, low and high frequency markets, private markets, reporting, all of this. I mean, naturally, this is what I specialize in. And I do think that there's this really big opportunity for private real estate to function at a higher level, whether that's ownership outright or the investment structures or the capital stacks pertaining to those individual assets, because we're going to be able to aggregate, collect, structure, verify, and utilize data at unprecedented levels. I'm very optimistic about prop tech, whether that's just general software as a service or AI for structuring the data, or really ML for structuring the data and making predictive analytics out of that, and then also deploying that in unique cases. And then if those documents and data sets can be cryptographically verified under the surveillance of the portfolio managers, the asset managers, like locally,
Exactly.
they don't have to send off to a central authority the same way that a REIT would. You're going to see unprecedented levels of transparency in the real estate market, and then also this institutional grade by default. Like it'll be audit ready by default, where the software is just packaged in a way that it's what the institutions were already doing with these large teams, right? They hire tons of
Exactly.
people, they're doing 10-finger automation, and yet the little developer, the little property manager is going to be able to do the same thing. And that's going to dramatically increase the quality and the efficiency, and then hopefully put less strain on the margins, which is going to have this softening effect on the rents and the increase of that, and then hopefully improving the quality of the assets themselves.
Exactly. Exactly. I
And
mean,
and
Matthew,
it's too exciting.
I didn't want to advertise ReFin Quant, to be honest, but I mean that's the gap we have, right? I mean, if you think about Brookfield or other big institutions, they can build up like a floor full of data scientists, and they have the capital to inject and to look into that domain, but not the small and mid-sized property companies or investors. So there's a really huge gap going on there. And transparency. I mean, the frequency problem of real estate creates a huge transparency, and also documentation. I mean, we didn't touch that much, but think about lease contracts, zoning. I mean, whatever it is, like you tell me. So all of these, like the supply chain in real estate, we need transparency, and there are lots of documentations that investors use. And I agree. I mean, again, I'm not the blockchain expert here, but I see like a big opportunity there, because transparency is everything. And we, by nature of the business, it's not that the investors in the market, but the nature of the business lacks transparency. And I think blockchain, data analytics, data science, AI, I mean, all of these help greatly on that. Yeah.
Well, it also lacks accountability,
Yeah.
which we could start really high level, pointing fingers at institutions and immediately saying this is their fault. Meanwhile, there's labor shortages, there's this generational wealth transfer that is slowly happening but not quite happening,
Yeah.
like all these other things, and
Yeah.
then saying no, it's the 0.2% of the market. That's one example of accountability. But real estate in general has an accountability issue across the entire life cycle of an asset, whether you're talking pre-development and design, the construction, handover, operations. There's all sorts of issues there, and it has this compounding effect. It's remarkable that these industries and these markets are as reliable as they are, because they're nearly held up
And
with popsicle sticks and a little bit of
yeah.
chewing gum. It's
Yeah, I mean, think about even like a very large institution, right? I mean, they have different teams for each, like a different team for pre-development, different team for development, different team for acquisitions, different team for tenant relations or finding tenants, and these are like it's a very large, steps and cycles, and it's difficult to bring that accountability you mentioned together. It's not easy, and again, technology can help greatly here. Yeah.
Hyperfragmentation.
Yeah.
Yeah,
Exactly. Exactly.
absolutely. And the
Exactly.
loss of data that would help us make some of these
Exactly.
decisions.
Yeah.
But hopefully we'll see some changes over the next few years, maybe the
Yeah.
next decade. I know that that's what we're pushing for,
Yeah.
of course, with our products, but then in terms of education and advocacy and
Yeah. 100%.
paying our respects to not just platforms and tech, but also people, process, and purpose. All of that involved in saying, how can we build better real estate markets, more equitable real estate markets, and then also understanding capitalism and
Exactly.
what's going to drive the
Exactly.
development in the end. My final question to you,
Yeah.
what are you going to be working on throughout 2026? Is there anything that you would like people to tune into, and where
I
can they
mean,
do that?
like I try to build up also like a industry profile with ReFin Quant. So I mean, research goes on. I have like still I have mortgage papers, AI paper, I have this rental paper. We are looking into jumping to data center because there's also lots of activity going on, and there are lots of questions to be answered there. So those are more the academic side. In the industry side, I think I'm really much into AI, and see how I can help with the teams I work with, companies to integrate AI into their domain, because there's lots of uncertainty going on. And I think there's one thing we should be careful about AI as well. Like, so everybody's trying to do AI, especially like you go to Claude or ChatGPT and ask develop models, but we shouldn't miss out the expertise and the context. So that's why I think what you are doing is incredibly great. So without having the domain knowledge, it's not easy. And there are like lots of AI models flying around. So I think domain expertise is really important. So I'm just like trying to be in that part, connecting the two. Like, there's AI, data analytics, and then there's domain knowledge, because those models need definitely domain knowledge, and it's becoming more important. I think that's like, I'll just explore that part. So, things are changing fast. I'm very curious, and I just want to be up to date on those developments.
100%. I have to jump in again because I
Yeah, of
just
course.
I just spoke at Contractors Closes and Connections, CCC. They have what would you call it, chapters all throughout the US, and I went to one in Savannah, Georgia. The topic was prop tech. And I thought, what do I really want to cover? A lot of folks are going to be excited about artificial intelligence. I'll start there, but then I'm going to come in here with this haymaker, this punch that says,
Yeah,
actually caught you off guard. AI is cool, but it's not a silver bullet. Here's what I want all of you as
exactly.
stakeholders and operators and investors to be thinking about, which is that a lot of these tools, which are really consumer AI, they're not enterprise, they're consumer AI, they can operate broadly. The data that we're feeding them is narrow. And then, as you said, when you leave out that context or information, broadly speaking, or wisdom as we know it, because as information accumulates, we can then juxtapose or maybe contrast what's
Yeah,
happening here versus what's happened in the
yeah,
past and draw conclusions from that. AI cannot do that. And so if you think that you can just attach it to a tool, but then that tool is siloed from other things going on in your portfolio or the property or the market at large, or
exactly.
it starts breaking the laws of physics, then you have this mess. And so I said to people, I really want you to be thinking about your digital transformation process. And this goes back to the data portion. We're scraping for market data here, or rent data, or acquisition, because it's hardly accessible. So I want people to go through the process of digitizing, organizing that data, structuring it, know how to index
Exactly.
it, know how to put it to use, and then you can start to strategically apply tools on top of that. But you need to know exactly what you want
Up
out of
to
that tool.
Yeah, how to restructure the data, right? You should know, I mean, there's raw data, but you need to understand how to restructure the data in a way that makes sense in the real estate context. So,
Hmm. Hmm.
and
But I
yeah,
should get off
right.
my soapbox, but I'll give you the closing remarks here.
Yeah, I mean, it's just like, I mean, this like the final part is of course super interesting with what's going on. I mean, as we discussed, like domain knowledge is very important. Let me say one last thing about AI. So I tell this to myself. Just think about real estate. The easy question you can make is that, like, let's say stick to the question that I was asked at the bank. So what will happen to the prices in Montreal? So you can write it down to Claude ChatGPT, right? So if you write the question this way, you will only get the average answer. And more or less, of course, it's not standard right now, but more or less everybody will get the same answer. So, like, if you ask a question without domain knowledge, you'll get the average answer, and everybody will get that average answer. But if you have the knowledge and the context, then AI becomes like, AI can be better as much as you know what you are doing and the domain you are working in. So then it becomes like a tool. I think that's the true way to think about AI and these things. It's really like, it can only get better as much as you get better, and then and you are specialized in what you are doing, and then it becomes a tool. But in the end, it's your knowledge made to you, or it's the person's knowledge. In the end, it should be used as a tool. I think that's really critical to understand. And progress is there. So, but we shouldn't forget that we still need to learn. So otherwise, it's very problematic. Yeah,
Absolutely. Well, it's in that information asymmetry that you have the
exactly.
opportunity for arbitrage. It's when you
Ex-
know something in addition to what the AI tool is telling you that you get an edge in the
exactly.
market.
Yeah.
Well, this has been a
Very
wonderful
exciting. Yeah,
conversation.
same for me.
We
Yeah,
got to cover a lot, demystifying institutional
yeah,
investor activity in uh, in the housing market and its impact on rents and home ownership and housing prices, and then a little bit cherry on top talking about
yeah.
all the
We still
different
touch
tools
there.
that will
Yeah,
change the market in the end. Awesome. Well, I'm going to provide links to, I think I have your LinkedIn, and
yeah,
we'll have links to maybe some of your papers as well so that people
yeah.
can do reading of their own.
Of course.
Seeing is believing. Go look at the data. Data's there.
Exactly.
And if people want to dispute it, we can do some peer review and
Yeah,
some
exactly.
rebuttals.
Exactly. Yeah. Thank you very much, Matthew. I mean, it was like super fun, to be honest. Yeah.
Yes. Thank you very
Thank you.
much.
Thank you very
Well,
much.
until next time.
Yeah.
Take care then.
Take care. Bye bye.